Hello and welcome. This guide comes to you from the team at Pro Tax Accountant, and today we're breaking down everything you need to know about the dividend tax rates for 2025-2026. We're going to kick things off with a number that represents a quiet, creeping tax increase that is catching so many UK business owners completely by surprise.
You see, just a few short years ago, this number was £2,000. Then it was halved, down to £1,000. And now, for the 2025-26 tax year, it stands at just £500. We are talking, of course, about the tax-free dividend allowance.
So what on earth does this dramatic reduction really mean for your bank account? It's a perfectly fair question, and it's one we're going to break down for you piece by piece so you can plan effectively for the year ahead.
To get you there, we'll cover that shrinking allowance and why it matters so much. We'll look at your core tax-free allowances and how they all work together. Then we'll get into the dividend tax rates themselves, before putting it all into practice with some real-world examples. And we'll finish up with smart planning strategies and your key next steps.
Right, let's get into it. We're calling this a creeping tax increase, for a very good reason. Many business owners are simply unprepared for the impact of this shrinking dividend allowance, and it's absolutely vital to understand what it means for your finances.
What's really striking here is just how quickly this has all happened. I mean, look at the timeline. Back in the 2022/23 tax year, you had a £2,000 tax-free buffer. The very next year, that was slashed to £1,000. In 2024/25, it was halved again to £500, and that's the level it's staying at for the 2025/26 tax year we're talking about today.
And you know, this catches a lot of people out. The crucial point here is that more of your dividend income is now subject to tax, even though the main rates you hear about on the news haven't actually changed. It's a policy that effectively broadens the tax base, pulling more of your money into the tax system without any big headline-grabbing announcements.
Okay, so let's move on and see how this all builds up, because it's absolutely vital to understand the two main allowances you have. The best way to think about them is as two different buckets that you need to fill correctly to be as tax efficient as possible.
Now, your first and your largest bucket is your personal allowance, which for 2025/26 is frozen at £12,570. This is really the foundation of all your tax planning. It's the amount you can earn from any source, be it salary, rent, whatever, without paying a penny of tax. For most company directors, this is typically used against your salary first.
Okay, here's where most people get confused. Your second, much smaller bucket is that £500 dividend allowance. Now, this is not an extra £500 of tax-free income on top of your personal allowance. Instead, think of it as a special 0% tax rate that applies only to the first £500 of your dividend income and only after your main personal allowance has already been used up.
And this slide brilliantly illustrates that key distinction. The personal allowance on the left applies to all your income and directly reduces the amount of money you pay tax on. The dividend allowance on the right, it applies only to dividends and simply changes the tax rate on that first small slice to 0%. They are two very, very different tools in your tax planning toolkit.
Okay, let's dive into this. Once you've used up those allowances, what happens next? Well, this brings us to the actual 2025/2025 dividend tax rates. These are the numbers you really need to get your head around.
So the crucial point on this slide is that the tax rate you pay on your dividends depends entirely on your total income band from all sources, not just your dividends. If your total income places you in the basic rate band, any dividends above that little £500 allowance are taxed at 8.75%. If it pushes you into the higher rate band, that rate jumps significantly to 33.75%. And for additional rate taxpayers, it's a hefty 39.35%.
So, how do you figure out which band you actually fall into? Well, it's a simple three-step process. First, add up all of your income from every single source. Second, subtract your £12,570 personal allowance from that total. And third, take the number you're left with. That's your taxable income, and just match it to the correct band we just looked at. It's as straightforward as that.
Now, a quick but very important note for our viewers in Scotland. While your earned income, like a salary, is taxed using the distinct Scottish rates in bands, these UK-wide rates that we've just discussed are the ones that apply to your savings and dividend income. It's a common point of confusion, so it's definitely one to remember.
Right. Theory is one thing, but let's make this simple. We're going to apply these rules to a couple of common scenarios that will be very familiar to many business owners across the UK.
So let's meet David. He runs a small consultancy up in Manchester and pays himself using a very common and tax-efficient mix of a small salary and dividends.
So as you can see, David takes a director's salary of £12,570, which is set precisely at that personal allowance threshold we discussed. On top of that, he takes £20,000 in dividends from his company's profits. This gives him a total income of £32,570 for the year.
Now let's break this down. His salary of £12,570 is completely covered by his personal allowance, so the tax on that is zero. Simple. Of his £20,000 in dividends, the first £500 are also tax-free thanks to the dividend allowance. This leaves $19,500. Because his total income keeps him well within the basic rate band, these are taxed at 8.75%, which comes to $1,706.25. And that's his total tax bill for the year.
Okay, now for a different example. Let's meet Sarah, a successful freelancer based in London. And stay with me here. This next point affects nearly every growing small business. It shows exactly what happens when your success pushes you into a higher tax band.
Sarah has a pretty similar salary structure, taking that same £12,570. But as her business has really taken off, she now takes significantly more in dividends, £50,000 to be precise. This gives her a total income of £62,570 for the year.
So how does Sarah's tax work out? Well, her salary tax is zero. The first £500 of her dividends are tax-free. Now the next slice of her dividends, that's £37,200, uses up the rest of her basic rate band, so that's taxed at 8.75%. But here's the crucial part. The remaining £12,300 of her dividends are pushed into the higher rate band, where they're taxed at that much higher 33.75% rate. You can see how quickly the tax bill climbs, giving her a total bill of over £7,000.
But that's not all. This next change is even more important. You see, knowing the rules is one thing, but using them effectively to plan ahead is something else entirely. You'll definitely want to hear this part.
So here's a pro tip for you. Despite all the changes, a low salary combined with dividends remains, for most company directors, the most tax-efficient way to get paid. The crucial point here is that you're using your personal allowance for salary while also leveraging the fact that dividends are not subject to national insurance contributions, and that is a huge saving.
And for your personal investments, this next point is an absolute game changer. Did you know that any dividends held within a stocks and shares ISA or a SIP, that's a self-invested personal pension, are entirely tax-free? They don't use up your dividend allowance and you don't even need to report them to HMRC. It's an incredibly powerful way to grow your investments.
Here's another pro tip for you. If your business structure allows for it, seriously consider splitting shares with a spouse or a civil partner. This is an extremely effective strategy because it lets you use two sets of allowances, two personal allowances and two dividend allowances. For many businesses, this can significantly lower the overall household tax bill.
Right, so let's quickly recap the most important points from all of that and outline what you should be thinking about next as you start to plan for 2026.
If you remember anything, make it these 4 points. First, the tax-free dividend allowance is just £500. Second, the rates are 8.75%, 33.75%, and 39.35%. Third, and this is critical, your total income from all sources is what determines which rate you pay. And finally, because of that tiny £500 allowance, proactive planning is no longer just a nice-to-have, it's an absolute necessity.
And of course, we must stress that this information is for general guidance only. Tax law is incredibly complex and it's always subject to change. Your personal circumstances are unique, so you should always consult a qualified professional before making any financial decisions.
So, if you're ready to plan properly for 2026 and you want advice that is tailored specifically to you and your business, the very best thing you can do is reach out to the experts at Pro Tax Accountant. Their details are right there on the screen, and you can read the full detailed article this is based on by visiting their website.
And finally, if you found this useful, please do subscribe to the Pro Tax Accountant channel for more clear, practical advice that can help you and your business stay ahead of the curve. Thank you so much for watching.